Hi everyone, in this video I'll show you how to add moving averages in TradingView. I'll also cover the difference between simple and exponential moving averages, how to add multiple moving averages, and a beginner-friendly moving average crossover strategy. Let's start. A moving average is an indicator that smooths out price movement to help traders identify the direction of the trend. Instead of focusing on every candle movement, moving averages help you see the bigger picture. In general, if the price is below the moving averages, it suggests bearish momentum. If the price is above the moving average, then it suggests bullish momentum. First, open your chart in TradingView. Then, at the top of the screen, click on Indicators. In the search bar, type in moving average or MA for short. I'm going to go with the simple moving average. And now the moving average has been added to the chart, but we want to edit it. So we hover a mouse over it, right click and click on Settings. Here we can adjust the color of the moving average. We can adjust the thickness of the moving average to make this more visible. And we go to Inputs and we can adjust the length of the moving average. So do we want the moving average to be more short-term oriented, like a 9-period moving average, or longer? So for example, if I change this to a 50-period moving average, as you can see, the moving average has been updated on the chart, and now it's more of a long-term trend indicator. Now I want to talk about the two most popular moving averages, which is the simple moving average, which we have added, and the exponential moving average, or EMA for short. And the main difference is how they calculate the price data, but both moving averages will look differently on the chart. A simple moving average treats every candle equally in the calculation. So for example, if we used a 20-period simple moving average, the candle from 20 candles ago has the same importance as the most recent candle. Because of that, the simple moving average moves more slowly and appears smoother on the chart. Now I will talk about the exponential moving average. I'll add it first to the chart, click on Indicators, and MA is already typed in here, so I'll select moving average exponential. And let's format the EMA to a 20 period as well. Let's make it thicker. Slightly change the color. For the inputs, I will select 20. The EMA moves a little bit differently, and it gives more importance to recent candles and less importance to older candles, which means that on a chart, the EMA is always first to react. So here we had a strong downtrend, and what happens here is the price moved up, the EMA moved first, whereas the simple moving average was lagging behind it. Then the price went down, EMA moved first. Here as well, anytime there is an uptrend, the EMA is always above the simple moving average, and when there is a downtrend, the EMA will be the first one to move. One popular beginner strategy is the moving average crossover. Let's add two moving averages. Let's go with we can type in moving average and moving average exponential. I'll add two of them. Go to Settings, Style. This one will be the short-term moving average. I'll give it a red color, make it thicker. And for the input, I will set it at 20. And for the second moving average, this will be the trend-like indicator. I will make it thicker so it's more visible. Change the color slightly. And for the input, I'll set a 50-period EMA. Now, When the faster moving average crosses above the slower one, that may signal bullish momentum. When the faster moving average, which is the red line, crosses below the slower one, that may signal bearish momentum. As you can see here, we had a strong uptrend. The signal came here at the crossover. And then we saw a change in direction in the market and the signal crossed below here and it changed into a downtrend. But remember, moving averages are trend following indicators. That means they react after price has already started moving. So they work best in trending markets, not in a sideways market. Here's a quick beginner's tip. You do not need 5 or 6 moving averages on your chart. I find that too many indicators can create confusion. Most traders only use 1 or 2 or 3 moving averages. I find that if you keep your charts clean and focus on understanding price behavior around the averages, that will be more important. Here's another important concept. Moving averages can sometimes act as dynamic support or resistance zones. In a strong uptrend, price may bounce from a moving average. However, in a downtrend, like you see here, the price rejects the moving average. It keeps on bouncing once it touches the moving average. Then over here we have a consolidation period, so moving average doesn't do anything, the price just jumps above and below it. And then here we see that the price moved down, and when it touched the moving average, it kept going down, it kept bouncing down. Here we can see it crossed the moving average, and then instead of being a resistance, the moving average here became a support and price bounced off it. So this is why many traders watch the 50 EMA and 200 EMA closely, because these are trend following or trend identifying EMAs, and they are more accurate to detect these dynamic support and resistance zones. And that concludes this lesson, and that's how to add and use moving averages in TradingView. If this video helped you, feel free to subscribe for more beginner trading tutorials. Thanks for watching, and I'll see you in the next video.